everyone, welcome back to News and Brews. Today we're diving into some breaking economic news. The UK government's borrowing costs are skyrocketing and could hit the highest level we've seen in 34 years. So what's behind this surge? And why are we talking about Germany in all of this? Stick around because this could impact everything from interest rates to jobs and yes, your wallet. Right now, there's a growing gap between the UK's and Germany's 10-year bond yields. In fact, the spread between them has reached 228 basis points. Now, I know that sounds a bit technical, but what it means is the UK government is having to offer a much higher return to attract investors to its debt compared to Germany. It's kind of like a financial rollercoaster. UK bond yields are climbing much faster than Germany's, and this difference, called the spread, is now the biggest we've seen since Germany reunified back in 1990. That's 34 years ago. And for context, this surge even tops the spike we saw after Liz Truss's infamous mini-budget 2 years ago. So why is this happening? Well, it all comes down to inflation and wages. New data shows UK wages surged by 5.2% in the last 3 months. That's way higher than expected, and it's creating a real dilemma for the Bank of England. You see, rising wages can fuel inflation, making it harder to lower interest rates. And when traders saw those wage figures, they immediately slashed their expectations of interest rate cuts next year. Just a week ago, most people were expecting the Bank of England to cut interest rates 3 times in 2024. Now, there's just a 40% chance of that happening. If you were hoping for lower mortgage rates or cheaper loans next year, well, this might be disappointing news. Economists like Rob Wood at Pantheon Macroeconomics are saying that the Bank of England will need to be really cautious. They're balancing between weaker growth on one side and still strong inflation pressures on the other. And Andrew Wishart from Berenberg summed it up perfectly, saying Britain is facing a nasty cocktail of falling employment and rising pay. Not exactly a recipe for quick interest rate cuts, right? So, to sum it all up, the UK's borrowing costs are on track to reach their highest level in 34 years. Wage growth is fueling inflation concerns, making it harder for the Bank of England to cut interest rates. And the gap between UK and German bond yields, the biggest in decades. Now, what does this mean for you? Well, if you've got a mortgage, if you're thinking of taking out a loan, or if you're just interested in the UK economy, these shifts could have a real impact on your finances. But as always, it's a fast-moving situation, and we'll keep you updated as things unfold. Thanks for watching. If you found this breakdown helpful, don't forget to hit that like button and subscribe to News and Brews for more updates on the UK economy and global financial trends. See you next time.